All right, let's dive into this explainer. Today, we are going to uncover the true mechanics of wealth, moving from the chaotic global scale of Bitcoin all the way down to the exact dollar amount that fundamentally changes your personal life. We're going to strip away the emotional noise and just look at the cold, hard, structural reality of financial survival.
So here is our roadmap for today. We'll kick things off with 1, the Bitcoin zero myth. Move right into 2, 3 structural Bitcoin sellers, and 3, the real crypto risks. Then we pivot to personal finance with 4, the 20,000 threshold, 5, the math of momentum, and finally 6, walking away and wealth. Let's get right into it.
Section 1. The Bitcoin Zero Myth, Separating Emotion from Data. We're starting with what is, without a doubt, the most emotional asset on the planet. Recently, Bitcoin saw a grueling 48% drawdown from its peak, literally taking half of investors' money in just 9 months. And that leaves everyday investors like, say, a woman named Lindsay in Sacramento who is sitting in a parking lot 43% underwater, just totally stressed and questioning everything. The emotional temperature here is running way ahead of the actual data.
Now, what is actually super fascinating here is that even Peter Schiff, who is arguably the most committed Bitcoin bear alive, won't explicitly predict an absolute zero. When he was handed a clean opportunity to predict zero, he backed off. Instead, he frames it as a 99% functional loss. The bears aren't actually arguing for zero anymore. They're arguing for an asset that lives forever but just never pays you back inside your investing lifetime.
Just look at this number, 475. That is the exact number of times Bitcoin has been publicly declared dead in an actively maintained obituary database. And the first one? That was back when it cost 11 cents. If you'd invested $100 every single time someone declared it dead, you'd have around $67 million today. It just proves that listening to the absolute extremes, the pure panic, is a terrible investment strategy.
And this illustrates perfectly why this current drawdown feels so agonizingly different for everyday investors. Historically, crypto experiences these violent crashes of 77 and 93%. They're fast, they produce intense panic, and that panic eventually produces a bottom. But this time, it wasn't a crash. It was a 9-month staircase of sheer exhaustion. Step, pause, step, pause. It slowly drains retail investors and creates this very specific 2 a.m. feeling where you actually stop being scared and you just start being embarrassed.
Section 2. 3 structural Bitcoin sellers, the plumbing. So the exhaustion we were just talking about, it wasn't caused by some sudden shift in global belief about digital currency. It was actually caused by cold mechanical market plumbing taking over the system.
The absolutely crucial point to understand is that institutional adoption didn't bring the adult stability everyone was promised, it brought synchronized, schedule-based sellers who do not care about the vibes. First, you have ETFs, which now explain roughly 45% of Bitcoin's weekly price movement. And it turns out, plumbing doesn't have conviction, it has redemption schedule. Second, the miners. A guy named Dale running rigs in a Kentucky horse trailer didn't sell his coins because he lost faith, he sold because January was freezing cold and his massive power bill was due. And third, corporate treasuries. Companies like MicroStrategy had to authorize selling up to $1.25 billion of Bitcoin to cover cash reserves and preferred dividends. They all became net sellers in the exact same 6-month window based entirely on spreadsheets, not emotion.
Section 3. The real crypto risks. Halving and quantum threats. Because if a sudden crash to absolute zero isn't the real danger, we need to look at the slow, structural decay actually facing the network.
Think of our miner, Dale, kind of like a bouncer at a nightclub. He gets paid a guaranteed salary plus tips. Right now, the tips are just a fraction of a percent. The fixed salary is everything. But because of the halving, every 4 years, the club cuts his salary in half. So by 2036, his salary's down to roughly an eighth of what it is today. Meanwhile, the club, the network itself, keeps getting bigger and is guarding over $1 trillion. How does a guy guarding $1 trillion network work for a fraction of what he makes right now? It's a massive structural flaw that resolves in a decade, which is exactly why nobody wants to put it on a sensational article cover.
Add to that a dramatically real technological threat. Earlier this year, a proposal called BIP 360 laid out a plan to potentially freeze roughly a third of all Bitcoin. Why on earth would they do that? Because over 34% of all Bitcoin has revealed a public key, which makes it highly vulnerable to future quantum computing attacks. To protect the network, they might literally have to permanently freeze millions of coins. And that includes an estimated 1.7 million coins believed to belong to Satoshi Nakamoto himself. Think about that for a second. To protect money that cannot be confiscated, they may actually have to confiscate a third of it.
Section 4, the 20,000 threshold, escaping survival mode. Now, let's move away from the macroeconomic noise and risks of global assets, and let's zoom in on the microeconomic reality of your own wallet. Because whether it is crypto or just boring old index funds, wealth isn't built on vibes. It is built on crossing specific, invisible mathematical thresholds.
When you are sitting on zero savings, your brain operates in what psychologists call survival mode. Every single financial decision is filtered entirely through fear and scarcity. You might take terrible job offers or stay in situations you absolutely hate simply because you literally cannot afford to be picky. Your brain cannot think about long-term growth or opportunity because all your mental bandwidth is entirely consumed by putting out immediate, short-term fires.
But Vanguard data reveals something pretty incredible. Just having $2,000 in emergency savings gives you a massive 21% boost in financial well-being. It starts to pull you out of pure panic. But pushing that to a 3 to 6 month buffer, which for most people is roughly $20,000, gives you an additional 13% boost. At this threshold, you fundamentally rewire your brain. A broken laptop or a surprise car repair goes from being a catastrophic financial emergency to just a minor inconvenience. You finally have the breathing room to spot wealth-building opportunities instead of just constantly bracing for the next threat.
Section 5, the math of momentum, pushing the boulder. Getting to that first $20,000 is for sure the hardest part. It's like pushing a massive boulder up a really steep hill. It takes intense discipline, tracking every dollar, and constantly delaying gratification. But once you crest that hill, gravity takes over. Let me show you how this actually builds. If you're saving $1,000 a month at an 8% return, that first $20,000 takes 19 exhausting months. But your second $20,000? It only takes 17 months. You did the exact same amount of work, but you shaved 2 full months off because your first 20 grand is now working alongside you. And watch what happens later on. By the time your portfolio hits $400,000, compound interest generates that exact same 20 grand in just 5 months, entirely automatically.
It turns out the ultra-wealthy aren't relying on some secret cheat code or exclusive hedge funds. Actually, they're just letting this exact same basic math operate at a much larger scale. A 10% return on $2,000 is $200. I mean, it's nice, but it doesn't change your life. But take that same 10% return on $20,000, and suddenly you've got $2,000 of pure profit. That is money that actually matters, flowing right into your account without you lifting a finger. Scale is what turns insignificant percentage wins into serious passive cash flow.
Section 6, walking away and wealth, the true cost of things. Crossing this $20,000 threshold doesn't just change your bank account. It completely changes your career. It gives you walking away money. You can negotiate your salary or push back on a toxic boss from a position of absolute strength, because you know you could survive for months if you had to. It also frees you from obsessing over minor expenses, like skipping a $3 coffee, so you can focus all your strategic energy on major life choices, like housing, your career trajectory, and big investments. And speaking of major life choices, let's talk about the true cost of things for a second. The average person will drop $400,000 on transportation over their lifetime, complaining the whole time that they can't save for retirement. That flashy $30,000 new car loses 20% of its value the second you drive it off the lot. But more importantly, when you factor in a 20-year opportunity cost of having that money in the market, that car isn't costing you 30 grand. It is actively destroying $200,000 of your future wealth. Once you have a strong financial foundation, you stop asking, can I afford the monthly payment? And you start asking, what is this costing my future? So we arrive at the ultimate test. Whether you're trying to understand the cold structural realities of global assets like Bitcoin, or you're just trying to master your own personal compound interest, the math remains exactly the same. It shows us that we absolutely have to stop sweating the small stuff and look at the big systemic picture. It leaves us with one massive question. Are you going to stay trapped in survival mode, letting fear dictate your choices, or are you ready to build that foundation and mathematically design your freedom?